Welcome back. We start off with Europe, where the European Central Bank policymakers have signaled additional interest rate cuts on Friday, just a day after the bank implemented its fourth consecutive rate reduction, bringing borrowing costs down to 2.75%. Additionally, the bank lowered its weekly bank lending rate to 2.90% and its overnight lending rate to 3.15%. Officials, including Finland's central bank chief Olli Rehn, expect monetary policy to ease by summer. Inflation forecasts remain mixed, with some ECB surveys showing rising expectations, while data from France and Germany suggest a faster decline. A rate cut in March remains the baseline scenario. European Central Bank President has stated that the Eurozone economy still faces challenges, but expects rising real incomes and easing monetary policy to boost demand, highlighting the strengths of the labor market, with unemployment steady at 6.3% in December.
The economy is still facing headwinds, but rising real incomes and the gradually fading effects of restrictive monetary policy should support a pickup in demand over time. While the labour market has softened over the recent months, it continues to be robust, with the unemployment rate staying low at 6.3% in December. A solid job market and higher incomes should strengthen consumer confidence and allow spending to rise.
Preliminary data from the Statistics Office has shown that Germany's economy shrank by 0.2% in the fourth quarter of 2024, more than the 0.1% decline expected. The downturn was driven by high energy costs, weak trade, and political uncertainty ahead of the February 23 snap election. Business sentiment indicators show a little sign of near-term improvement, with economists warning of continued stagnation. Germany's GDP also declined in 2024, marking the second consecutive annual contraction. The government has now lowered its 2025 growth forecast to 0.3% from 1.1%, citing global trade tensions and domestic instability. Moreover, preliminary data has shown that Germany's inflation held steady at 2.8% in January, in line with expectations, while core inflation, excluding food and energy, dropped to 2.9% from 3.3% in December. The weak economy and high energy costs continue to impact the labor market, with unemployment rising to 6.2%, the highest in over 4 years. Despite this, inflation in the Eurozone remains above target, with the European Central Bank expected to continue rate cuts, although concerns persist over inflation expectations. Figures from the Federal Labor Office have shown that Germany's unemployment rate rose to 6.4% in January, with 2.993 million people unemployed. While the number of unemployed increased less than expected, seasonally adjusted data showed an increase of 11,000 jobless individuals, bringing the adjusted job rate to 6.2%. Analysts anticipate the unemployment rate to exceed 3 million by early 2025, marking the first time in 10 years. A slowdown in labor demand was noted, with job openings falling by 66,000 year-on-year in January. The Kremlin responded to U.S. President Donald Trump's renewed threat to impose tariffs on BRICS countries if they create a shared currency, clarifying that there were no such plans. Kremlin spokesman Dmitry Peskov stated that BRICS, which includes Russia, was focused on establishing joint investment platforms rather than creating its own currency. Peskov suggested that U.S. experts should provide Trump with more information on BRICS activities.